The materiality concept is a fundamental principle in accounting and financial reporting, forming one of the cornerstones of how information is selected, presented, and interpreted in financial statements. At its core, the materiality concept dictates that only information that could influence the economic decisions of users should be included in financial reports. This principle ensures that financial statements are not overloaded with immaterial details, allowing stakeholders to focus on information that truly matters for their decision-making processes. Materiality is inherently a relative concept rather than an absolute one. What is material in one context may be immaterial in another, depending on the size and nature of the item in question, as well as the specific circumstances of the entity. For instance, an error of $10,000 might be highly material for a small business, but negligible for a multinational corporation with billions in annual revenue. The determination of materiality thus requires professional judgment, taking into account both quantitative factors, such as the size of the misstatement or omission relative to key financial statement figures, and qualitative factors, such as the nature of the transaction or event. The origins of the materiality concept can be traced back to the broader objective of financial reporting, to provide information that is useful to present and potential investors, creditors, and other users in making rational investment, credit, and similar decisions. If financial statements were to include every single transaction, regardless of its significance, they would become cumbersome and potentially misleading. Users could become lost in a sea of trivial details, obscuring the information that truly affects their assessments of an entity's performance and position. Materiality thus acts as a filter, ensuring that only relevant information finds its way into the reports. In practice, materiality is applied at every stage of the accounting process, from the initial recording of transactions to the final presentation of financial statements. Accountants must continually assess whether an item is material enough to warrant recognition, disclosure, or adjustment. For example, a company may decide not to capitalize low-cost assets like staplers or calculators, instead expensing them immediately because their cost is immaterial to the overall financial picture. Similarly, minor errors discovered after the preparation of financial statements may not necessitate restatement if their impact is deemed immaterial. The International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, both emphasize the importance of materiality. According to IAS 1, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general-purpose financial statements make on the basis of those financial statements. The Financial Accounting Standards Board, FASB, in the United States echoes this sentiment, defining materiality in relation to the magnitude of an omission or misstatement of accounting information that, in the light of surrounding circumstances, makes it probable that the judgment of a reasonable person relying on the information would have been changed or influenced by the inclusion or correction of the item. Quantitative thresholds are often used as guidelines for determining materiality, although there is no universally accepted benchmark. Commonly, auditors and accountants use rules of thumb, such as a percentage of net income, total assets, or revenue, often in the range of 5% to 10%, to assess whether an item is material. However, these are merely starting points. Qualitative considerations can override quantitative measures. For instance, a small monetary error may still be material if it involves fraud, violates legal or contractual requirements, or affects compliance with regulatory standards. The application of the materiality concept extends beyond the preparation of financial statements to the auditing process. Auditors must assess materiality when designing audit procedures, evaluating audit evidence, and forming an opinion on the financial statements as a whole. Materiality serves as a threshold for identifying significant misstatements. During planning, auditors establish an overall materiality level for the financial statements and may set lower thresholds for particular classes of transactions, account balances, or disclosures where users are particularly sensitive to misstatements. Materiality also plays a crucial role in disclosures. Not all information that is recorded in the accounting system needs to be disclosed in the financial statements. Disclosures are required only for matters that are material to users' understanding of the financial statements. Excessive disclosure of immaterial information can obscure important facts and decrease the usefulness of financial reports. Standard setters and regulators have increasingly emphasized the need for concise, relevant disclosures, and materiality judgments are central to achieving this balance. The qualitative aspects of materiality are sometimes more challenging to assess than the quantitative ones. Certain transactions or events, regardless of their monetary value, may be considered material because of their nature or the context in which they occur. For example, related party transactions, even if relatively small, may be material due to their potential for conflicts of interest or implications for governance and control. Similarly, a breach of debt covenants, a change in accounting policy, or a significant legal contingency may be material because they affect users' perceptions of risk, management integrity, or future prospects. Materiality is not static. It must be reassessed in light of changing circumstances. As a company grows, what was once material may become immaterial, and vice versa. Economic conditions, industry developments, changes in user expectations, and evolving regulatory requirements can all influence materiality judgments. Professional accountants and auditors must remain vigilant, applying their expertise and ethical judgment to ensure that materiality assessments remain appropriate and relevant. The concept of materiality has also evolved in response to growing demands for transparency and accountability in financial reporting. In recent years, there has been increasing recognition of the importance of non-financial information, such as environmental, social, and governance (ESG) factors. Stakeholders are increasingly interested in how companies manage risks and opportunities related to sustainability, diversity, climate change, and other non-financial matters. The concept of materiality is being extended to encompass these dimensions, prompting organizations to consider not only what is material from a financial perspective, but also what is material to a broader range of stakeholders. This expansion of the materiality concept has significant implications for corporate reporting. Companies are now expected to engage with stakeholders to identify the issues that are most material to them using frameworks such as the Global Reporting Initiative, GRI, or the Sustainability Accounting Standards Board, SASB. These frameworks encourage companies to disclose information on topics that are material to their long-term value creation and societal impact, even if such information does not have an immediate financial effect. Despite its centrality to accounting and reporting, the application of materiality is not without controversy or challenge. Because materiality involves professional judgment, it can be subject to manipulation or abuse. Management may be tempted to use materiality as a justification for not correcting errors or disclosing unfavorable information. Auditors may face pressure to accept higher materiality thresholds to avoid costly or time-consuming audit procedures. Regulators and standard setters have responded by providing guidance and emphasizing the need for transparency in materiality judgments, but the risk of inconsistent application remains. To address these challenges, many organizations have established formal policies and procedures for assessing and documenting materiality judgments. These policies often require consideration of both quantitative and qualitative factors, consultation with senior management or the audit committee, and clear documentation of the rationale for materiality decisions. External auditors are also required to communicate their materiality assessments to those charged with governance, promoting greater accountability and oversight. Materiality is also closely linked to the concept of faithful representation, another key qualitative characteristic of useful financial information. Faithful representation requires that information be complete, neutral, and free from error. The materiality concept provides a practical limitation to this ideal, recognizing that striving for absolute accuracy in all respects is neither feasible nor necessary. Instead, financial statements should aim to be free from material misstatement, accepting that some immaterial inaccuracies or omissions may persist. In the context of digital reporting and the increasing use of technology in accounting, the materiality concept remains as relevant as ever. Automated systems can process vast amounts of data, but human judgment is still required to determine what information is material and should be highlighted for users. As artificial intelligence and machine learning tools become more prevalent in auditing and financial analysis, the challenge will be to ensure that these technologies are designed to support, rather than replace, the nuanced judgments required for materiality assessments. The materiality concept also intersects with the legal and regulatory environment. Securities regulators, such as the U.S. Securities and Exchange Commission, SEC, have issued guidance on materiality in the context of public disclosures, emphasizing the need for timely and accurate reporting of material events. In some cases, courts have weighed in on disputes over whether certain information was material, shaping the interpretation and application of the concept in practice. Another important aspect of materiality is its role in preventing information overload. In an era of increasing data availability, there is a risk that financial statements and disclosures become so voluminous that users struggle to identify what is truly important. The materiality concept serves as a safeguard against this risk, encouraging preparers to focus on information that is most relevant to users' needs. Materiality also interacts with other accounting principles and concepts, such as relevance, reliability, comparability, and consistency. While materiality helps ensure that only significant information is reported, it must be balanced with the need to provide relevant and reliable information that allows users to compare financial statements across periods and entities. The exercise of professional judgment in applying materiality should not undermine these other qualitative characteristics. The dynamic nature of business and finance means that materiality judgments must be continually revisited. As new risks emerge, business models evolve, and user expectations shift, the factors that determine materiality may change. For example, the growing importance of cybersecurity risks, data privacy, and digital transformation may elevate the materiality of certain disclosures that were previously considered peripheral. Similarly, the increasing focus on climate-related risks and opportunities is prompting companies to reassess the materiality of environmental disclosures. Training and education in the application of the materiality concept are essential for accountants, auditors, and other professionals involved in financial reporting. Professional bodies and standard setters provide guidance and case studies to help practitioners navigate complex materiality decisions. Ongoing professional development and ethical training are critical to maintaining high standards of judgment and integrity in applying the concept. Materiality also has implications for internal controls and risk management. Organizations must design their systems and processes to ensure that material information is identified, captured, and reported accurately and on a timely basis. This requires effective communication between different functions within the organization, as well as clear policies and procedures for escalating material issues. In summary, the materiality concept is a vital element of accounting and financial reporting, shaping the selection, measurement, and disclosure of information in financial statements. It serves as a filter to ensure that users are provided with information that is relevant and significant to their decision-making while avoiding unnecessary detail that could obscure key messages. The application of materiality requires professional judgment, balancing quantitative and qualitative factors, and taking into account the needs and expectations of users. As the business environment evolves and stakeholder demands expand, the concept of materiality is being redefined to encompass a broader range of financial and non-financial information. The ongoing challenge for preparers, auditors, and regulators is to apply the concept consistently and transparently, ensuring that financial statements continue to meet the needs of users in an increasingly complex and interconnected world. Through robust application of the materiality concept, accounting and financial reporting can fulfill their essential role in supporting informed economic decision-making and fostering trust in the capital markets.